Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, November 20, 2014. You're looking at a daily chart of the SPY, and I sound like a broken record, but we have more of the same. The market tried to put in a little bit of a sell this morning, didn't work out. Let's go to the intraday chart. Okay. Here is... Let's see. This is this morning. We go down, and immediately at 9:30, the market was down pre-market, right? A little bit. 9:30, we shoot back up and go sideways for the rest of the day. And the sideways move for the rest of the day kind of bodes well for a little bit of a bullish picture tomorrow. Now, I don't know how bullish it's going to be. This is a 60-minute chart. You see, we're up move. And then we moved sideways, and that kind of portends to another up move early tomorrow. Tomorrow's options expiration. It's Friday, usually light volume. So we could get an up move, but I wouldn't look for a big up move. And I'm going to have to change the picture a little bit in terms of the market correction, and we're going to postpone it a little bit because we didn't get it this week. And if we were going to get it, it really would have had to start this week during options expiration. Tried a couple of days to go down, didn't work out. They pumped the market right back up. And the reason I say we're postponing it is because next week is Thanksgiving, right? So we have... we're going to have half a day of market on Friday, which there'll be no volume. Forget light volume. There'll be no volume because nobody's going to come to work on Friday. And Wednesday, you're going to have light volume because it's the day before Thanksgiving. Thanksgiving is closed on Thursday. And Monday and Tuesday, anything goes. I just don't see a lot of action next week. It's usually a pretty light volume week during Thanksgiving if you go back year over year over year. So I would think nothing different will happen unless we have a catalyst, which you'll never see coming until it happens. But for the most part, don't expect a lot of action next week. So you're probably going to get light volume, sideways to slightly up move next week. And then once we get into December, we'll kind of put a little bit of the bear suit on again. Not too much, but we're still going to look for something similar to the down move we saw, or not that we saw, that we were expecting. We were expecting a move down to, well, now it's going to come up to almost like 198. On the SPY, and that might even be asking a lot at this point in time because we're going to start getting into the period of seasonality during the Christmas rally into New Year's. So you might have a week to maybe 8 or 9 trading days where we might see somewhat of a correction. But all in all, folks, that'll actually be a welcomed correction. Why? Because we'll get a Christmas rally, and we'll probably trade higher into the beginning of the year, and then we'll kind of see what happens from there, what the market looks like, what the pattern looks like, and then we'll take it from there into 2015. But that's what I see. So don't expect much down action over the next few days with Thanksgiving upon us, and that's just the way it is. We have to take what the market gives us, right? And I say this over and over again. I know I sound like a broken record, but we never trade our will on the market, or we never put our will on the market. We trade what the market gives us, right? Whatever the market tells us to do, we do. Right now, the market's telling us it's not going to go down, at least for the foreseeable future, for the next several trading sessions. That's what I see, so that's what we're playing. Never short a dull market, that's for sure. And, you can certainly be long some stocks, and I'm going to get into a couple of reasons why when we talk about gold and oil in a minute. But for the most part, just take it one day at a time, and the market's in float mode. Now, let's go to one of my favorite indicators that I talk about most often, which is the IWM. And the IWM was up today, albeit not on heavy volume. The volume was actually one of the lighter volume days, but never, which means there wasn't a lot of conviction from the institutions behind the move. So you didn't have a lot of funds buying the small caps. You didn't have a lot of that stuff. It was just basically more or less an options expiration spike up. And if you really want to know more about that, kind of pay attention to options expiration week. You'll see a lot of whipsaw action, just just like this morning and yesterday, market goes down, right back up. Individual stocks that are at highs tend to sell off a little bit. Stocks at lows tend to pop a little bit. And these are the institutions playing games with the individual equities for the most part. But so the IWM was up today, which is a pretty good tell if it continues up of what's coming, which is consistent with what I just said before, which look for some float higher into next week. All right, I do want to talk about one thing real quick, and this isn't an imminent move that I'm going to discuss, but this is something I don't talk about often, but I think it warrants it today. And this is JNK, which is the high yield or junk bond index. And basically, it's a basket of bonds that are usually non-rated bonds or rated junk, which means they're not investment grade bonds. And they're typically issued at higher yields than you would normally look for if you're a fixed income investor. So a junk bond could be issued at 7, 7.5, 8, 8.5, 9% yield. And why is that? Because they're risky. And sophisticated investors typically buy individual junk bonds. They understand how to read the financials of these companies, and they're willing to take the risk for the return. And that's why they're the high coupon bonds. Like an 8% or 8.5% bond is these days for sure is considered high coupon. And the reason it's there is because it has higher risk, meaning risk of default. And they're companies that are not financially healthy. But the reason I bring this up is because usually the high yield, let's go to the longer term chart before I explain further. And you look at a monthly chart, right? And this doesn't go back that far. I guess this index or this particular ETF came out only in 2007. But if you look here, it bottomed out at the same time stocks bottomed out in March of 2009 and basically went up with stocks. And now it's been moving more or less sideways, but it went up with stocks. If you look at a weekly chart, it's pretty much the same picture. Goes bottomed out in this is a shorter term. This is June of 2013, rallied up until June of 2014. Now started to chop around. But the reason I bring it up is because this is usually ahead of the stock market, and right now this is very weak. And this is very weak, meaning that the folks that are willing to take on the risk are pulling back from this index, which normally means that they will also pull back from the stock indexes as well. But usually the junk bond index is either a couple of weeks or even a month or so ahead of the stock indexes. That's typically what happens. So the reason I wanted to bring this up is because this has been real weak lately. And if you look, let's go, where is this? This is the middle of October, right when the stock market bottomed. Okay, so this moved up for a couple of weeks, topped out, and started to pull back, and the stock market kept going. So if this holds true, okay, maybe a week or two from now, after Thanksgiving, maybe into December, we may see the stock market follow and pull back. So this is not a perfect proxy, but it's something I've been noticing, and I wanted to bring it to your attention. It's another indicator, and we look for market tells. This is another market tell. Nothing's a perfect tell, but when we put some things together, usually we can get a pretty good picture of what's coming. So that's why I wanted to bring it to your attention. Let's swap over to the gold market. Now, gold was up today. This is the GLD chart. And gold was up today, and as we speak right now, it's trading at about $11.92 on the spot gold or futures contract. And let's go to the daily chart. And, it looks more and more like the evidence is pointing to that this was a bottom. This was around when futures contract was at 11:30 in an overnight session on the 5th of November. Now, you had this big up move, and as long as we continue to move sideways or even higher, there's going to be higher prices in gold. I think we put in a bottom in gold. That's my indication says a bottom is in, and it could be a very long-term bottom from what I can tell. So if that's the case, you're going to look for higher prices in gold. Our first target on the GLD is probably going to be about 118 to 119 area. Then we'll probably need to consolidate for a while and then another move higher. we're going to look for about 124 before we see any kind of a meaningful pullback, and that's a pretty good move. So the gold market looks poised. In fact, let me show you one other thing, okay? Because gold and silver don't always trade exactly the same, but they do trade in tandem a lot. And this is the same thing. It's putting in this sideways move and another couple, 3, 4 days of sideways move, and you can start to look higher in the price of silver as well. So what that's telling you is markets are being inflated. And I've told you before that with Japan inflating the markets and the ECB, what I believe is poised to inflate the markets by printing money. When the Federal Reserve printed money, it kind of got stopped at the U.S. banks, right? J.P. Morgan, Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo. The money kind of went into the banks, and that's where it stopped. And they used it for their own earning power. But Japan and Europe is different. Well, Europe's not on board yet, but I think they're coming. But Japan is flooding the market, and not only are they flooding the market, but they're buying equity, and that's one of the reasons why the market is staying so high, and it's just been so rising tide lifts all boats. Let's just put it that way. So if that is the case, which I believe it is, then we are going to see inflation. And whether we see real inflation in terms of how the government measures it, I'm not concerned about. What I am concerned about is if people think there's inflation. If the media thinks there's inflation, then people will run to buy gold and other commodity-related investments. And guess what? If people think there's inflation and they're buying gold or silver, then other people will start buying gold and silver. Okay, we don't buy things because the government says there's 2 or 3% inflation. We buy things because they're moving up and we think other people are buying them. That's ultimately the reason why, whether it's stocks or commodities or anything else are bought, is because other people are buying them. That's called a market. So the market drives them up and the market drives them down. Okay, so right now I think that gold is poised to move higher, and that's the way we're going to play it. So oil is next on the docket. Having trouble with the charts tonight. Okay, and last night I told you that the price of crude should get to about 77, and then we'll take it from there. Well, right now as we speak, we're at 76.40. This is the January contract I'm looking at, and we hit a high so far of 76.80, and that's pretty close. And I think there's going to be higher prices yet, but so far so good. So I think maybe the $74 level that we hit, or this low in the USO, is going to be good for a while. I still think that if we do move down, 72 was a target, and that would put the USO about $1 lower than it was at down here at 28, so maybe 27 and a quarter. But that's about it. So I'm not even sure we're going to get there at this point. It looks like we're moving higher, and I think it's all the same story, same as gold. I think it's the anticipation of inflation, and that's what's happening. So the reason that I bring this up is because there are some stocks that are moving higher in the energy complex. And so there is money to be made there, and the subscribers will be getting some alerts to that effect. So I think we're going to leave it there tonight. I'm David Frost, mystrategicforecast.com, and I appreciate everybody tuning in for another episode of Common Sense Market Analysis.